Hi, this is Mike Walther with your Oak Wealth Advisors 2026 market predictions. For those of you who've been with us before, you know that Oak Wealth Advisors doesn't actually make market predictions, and this next slide is going to show you exactly why we don't do that. On this slide, you can see the average market predictions from thousands of people making estimates in the financial services industry over the last 8 years. Going back to 2018 on the far right, you can see that there's an overestimate of market returns by 14%. The estimate was for a positive 7.5% return, that's the blue number, but the actual return was a loss of 6%. So not very good at predicting back in 2018. Didn't get any better from 2019 to 2021. The markets outperformed each of those 3 years with an underestimated prediction of between 14 and 26%. So again, terrible prediction ability. 2022, the market lost a lot of money when the expectation was for a small gain, so a 21% overestimate of performance. In the last 2 years, the predictions were 17 and 21% below what the market actually delivered. For 2025, so far it looks like we're going to be a little closer for the first time in the last 8 years. So what we should take away from this is that nobody is good at predicting future market returns. But that doesn't mean we shouldn't look at current valuations for understanding what to expect in future years. So let's start by taking a look at stock market valuations. In the lower quadrant of this chart, we can see different types of stocks: small, mid, and large, and going from left to right, value, blend, and growth. So large cap growth stocks, think of the Magnificent Seven: Apple, Microsoft, Nvidia, Meta, Alphabet, Amazon, and Tesla. Those stocks make up a good portion of the large cap growth space, and they are historically overpriced relative to historical norms. It's 150% of the typical pricing for those stocks, looking at a forward price earnings ratio. Conversely, look down in the bottom left-hand corner, small cap value, even small cap core and mid cap value. This space down here, relatively fairly valued, right? We're only at about 105 to 108%. So that's very close to historical norms. So there's currently better value in smaller companies with a value tilt. And if you're going to buy large cap growth stocks, expect to probably not do as well over the long term because you're paying a very high price under current market conditions. So that's our little thought about investing in equities. Let's look at fixed income. As I mentioned, the people predicting equity returns are lousy at doing that. Ironically, the people at the Federal Reserve, the Fed governors who set the rates, aren't even good at predicting the rates for the federal funds rate that they set every month or every quarter when they look at the numbers. As you can see to the right, their estimates are in blue. And if we were to go back and look at those numbers for what they're predicting after the period's already occurred, you'll see that they're very poor at doing that. They're predicting the rates are going to fall from around 3.6% currently down to about 3.1% over the next year, year and a half. So that's an expectation of declining rates. What will the actual rate be? We don't know. We can see that after rates peaked in 2023 at over 5%, they've since fallen down to about 3.5%. So that's been very good for bond investors over the last year and a half. And we would expect from the direction of that chart and the market expectations, or what people who are investing expect, is similar to the federal funds rate, but actually an even bigger decline in the short term, down to a 3.01% short-term interest rate. So the market and the Federal Reserve are both telling us rates are probably going to fall in the next year. As a bond investor, that's a good thing. Falling rates gives you a better price for your existing bonds, and coming from a relatively high level of interest rates, you're going to get a decent income return as well. So fixed income investing should deliver probably another good year of returns in 2026 if these numbers come to fruition. Again, nobody can predict the future. So with all that said, we hope that you'll stay disciplined and work with your advisor to make sure that your portfolio accurately reflects what you need for the future, with the understanding of where current interest rates are and where current market valuations are. And if you need more information about planning or other tools for making your family's future better, please come out and see us on our website at oakwealth.com. Check out our Special Needs Voice podcast. We'd love to share more information with you. You can find whatever you need there. And feel free to reach out to your advisor at Oak Wealth Advisors. We'd love to hear from you. With all of that, as I've said multiple times, you can't make any money making predictions, so don't do it. And all the advice here was given for informational purposes only. You should check with your advisor for what's appropriate for you and your family. With that, best wishes to everyone and happy holidays.